Hope everyone's having a good weekend. I wanted to discuss real quick. So I wanted to answer a few questions, and one is pretty much about, well, where's a good example? Stuff like this. Why is there, you get a bull trend or a bull channel, and then you get 3 consecutive bear bars, and then it seems like bulls give up. So the question is basically how strong trends rarely have 3 strong consecutive counter trend bars. It's usually 2 trend bars with bad follow through, and the trend keeps going. Al often stresses. Al Brooks is who he's referring to. You can find that more about Al Brooks at brookspriceaction.com. That's if you want the website, it's right there. I'll just leave it right there for now. So anyways, basically the question is why. Let's find a small pullback day. Here's a good one. Why is it that the bears will get 2 decent bear bars compared to the range, and this is a very tight channel, which is basically a small pullback bull trend? Why 2 bear bars but never 3? And the reason for that is a lot of swing traders, when we're in a channel, really don't want to see 3 bear bars, simply because here's kind of this is sort of similar, but here you had somewhat of you can argue a 50% pullback, and the bulls, for example, swing bulls who are long may get out at this close, but they're going to give, and they'll wait for a second entry. Here's the first entry, here's the second. So really, it doesn't mean just because the bears get 3 bars, it's going to turn into all the way from short. So, take this day, and there's not really, I'll make it green. So here I'll make this a little easier for everybody. Here's the session break. So this is the 5-minute S&P Emini futures chart. You can see there's only, here's 3 doji bear bars, but it's not really anything strong. So think about why is that. The reason is because the trend is, it's very tight, so yes, it's strong, but it doesn't appear strong. So bulls will buy, but they really want to buy a pullback. However, bulls will buy a small position, so here, and they'll buy maybe a small position here, stop down here, here. But their concern is it's a lot of trading range price action, so they don't want to buy a full position and price pull back all the way. So everybody wants to buy a pullback because it just doesn't seem that strong. Compare this to this. Very strong, very tight. So I'm going to go back to black. Black's bear bars, the white are bull bars. It's just, I like this more. So anyways, bulls are nibbling at every pullback. Here's a bear bar, they'll buy below, they'll buy this close, and they will buy during the next bar. So think about it. The bears really want 3 bear bars because it'll increase the chances of a second leg down, similar to here. First leg, second leg. This is a second leg down. It's all the bears got, and that is the minimum that they expected. They expected if they sold this close, they could at least scale in and get out at break even, which is exactly what they did. Here, decent, great bear bar, but no selling pressure. Great bear bar. Well, it's good context. You had a possible final flag, failed breakout at the high, and then we might be reversing down. But the thing is, bulls are going to wait until the bears are at their strongest. They'll short, so bears, smart traders are selling above, and they will short, and they'll scalp out here. Bulls are going to wait for one bear bar, a second bear bar, and they're going to buy during the next bar, betting that the bears will not get their third consecutive bar, especially when the range is this tight. similar to it's kind of here's another example. Type channel. You can argue, opening reversal, trend from the open. Not really trend from the open, but opening reversal, small pullback. 3 bars, good buying pressure, probably going for a measured move of some sort. The bears really needed one more bar. And when I say one more bar, I do not mean one more bar to make it always in short, meaning bears will swing short. I mean one more bar to increase the chances of trading range. For example, well, look right here. Look what happened. They got 3, 4, 5, 6 consecutive bars down, which greatly increases the chances that this will be a trading range and not continue with the channel. Okay, so look right here. I'll zoom in for everybody. So we have a trend from the open, small pullback bull trend. But there's one interesting thing about this day. Just so there's no doubt about what's a bull bar and what's a bear bar. Trend from the open since bar 2. Good. We haven't had a bull bar yet. I believe this is bar 10 of the day. Still no bear bar. But look at the buying pressure. It's not very strong. It's not great. Where are the good breakout, not great follow through, breakout, bad follow through? So this is kind of a hint. It's a hint that it's not as strong as it appears. It's strong, so I would not be shorting. But it's kind of a warning that later in the day, this could reverse and become a weaker, just basically do this. Look right here, 3 bear bars. This right here, these 3 bear bars down, does not mean that the market is no longer in a trend. It's not trending up. It simply means, well, it means that it's still trending up. All it means is the bulls are not as strong as they could be. And it increases the chances of trading range price action. However, until the bears can get below a decent bar, such as a decent swing stop here, which they did, but they didn't get below here, then it's really going to be a channel. So look right here, 3 bear bars. And then we got a breakout, bad follow through, breakout, bad follow through. Not really 3. I'll consider it pretty much 3 bear bars, but this is technically a bull bar. But you can argue it's the minimum for the bears as well. So anyways, and then look what happened here. 3 bear bars, 4, 5, bear breakout. We broke below the moving average for the first time today, and generally when you touch the moving average for the first time, think about it, the bulls were willing to buy an above average price for really a average market. Now we're at the average price, and this is the first time a trader could buy at the average price the entire day, and they didn't. So we had a breakout and follow through. Now, problem for the bulls. We're in a micro channel for the bears. The first reversal up should fail. Another bear bar, another bear bar, another bear bar. It's sell to close. However, it's a trading range. This is a lot. There's hints to the day. Trading range open. Dojis, trading range bars. 3 bear bars. More trading range price action than bullish small pullback channel price action. Dojis. Bad follow through after breakouts here, 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 here. This is a lot of trading range price action. There's always hints to the day. There's always. So when you see this, you have to be thinking, okay, we may, where are we going to go? Well, look right here. Here's a swing low. if you're a swing trader, this is an obvious place to put a stop as well as this. So it's also the right below the, it's close to the 15-minute moving average. There's a decent possibility once we start seeing this that we may test here, probably will test here. Think about what trading ranges do. They fall below obvious support and obvious resistance. They rise above obvious resistance. So, think about what's going on here. Why do we reverse as soon as we hit here and turn up? Well, think about it. It was a very reasonable thing to expect the market to fall below support. And those bulls, let's put it this way. Strong bears, or smart bears, we'll put it that way, they're selling up here. Strong bears are done selling. They're going to wait. They want to sell a pullback now because they know we're close to support and what's likely a trading range day, and probably not a bear trend. Decent enough rally where it's probably going to be a bear trend. It's also fairly close to 50%, which is in between these two. It's this line right here. So they're not going to sell, which means a couple things. The only people selling are weak bears, or the final surge of bulls, when they get stopped out, they will sell. However, smart bulls are looking to buy down here. They'll buy here. The buy as it gets close, and they'll probably use a stop down here. Very often, price falls below one support but not the next. So, I hope that helps. It's also, you can argue, a major trend reversal of 50% pullback. So, bull trend line break, and then we test it up to a new high. So, let me kind of look back over that question. Al often stresses the significance of 3 consecutive trend bars before setting a new always in. Maybe it's because 2 bars act like a 2 micro legs. Well, okay. That kind of goes into the whenever it's a weak trend or possible trading range. So let's just take this for example. But ignore the fact that price is 15 or so points above an average price, so the market's forcing you to buy. I think the Al used the example of it's like going to a car dealership and someone offering you a 1995 beat up car for the price of a new BMW, or a Mercedes. No one's gonna pay that. That's outrageous. So anyways, aside from that, if you were to just remove this, let's just do it right now. Okay, let's just look at this. No idea what the average price is. I don't even know what this trend line is. I'm going to delete that. So, look at the open. Usually, when you get a strong trend, you're going to get a decent, or usually when you get a decent swing, it's from a decent signal bar. So, strong trends usually form from a good signal bar. So, you've got to be suspicious about this. Look at this, breakout, not great follow through, two decent bull bars, but really high up. You got to be wondering a couple things. A, we're very far from the moving average. We can't see the moving average now. Second, this looks a lot like trading range behavior, and we may fall below here. If you're a swing bull and you bought, let's say, above here, anywhere in here, your stop's either below here or here. One thing you do not want to see is 3 consecutive decent bear bars, because this is not a strong trend. It's not a tight channel. It's not It's not this. So here's the problem, and it also has to do with when traders get trapped. Notice here, buy the close bar, and this goes into what out. This is kind of similar to Friday. Here's a close, bear bar, trap traders. Bulls still cannot get back to this close. Now we've had a third bar down, and more bulls cannot get back to the close. So what does that mean? Well, if you're an always in trader, I would probably, if I was long, I would get out of this close, no question. Because there's too much risk, and I know I'm drawing a lot of stuff, there's too much risk of this, maybe even this, to test yesterday's close. So look what happened here. By the closed bulls, they added on 1 point above, scalp got out break even. Anyways, remember what Al said Friday, for those of you in the room, whenever there's a reasonable buy the close, and even though price was very high and this wasn't strong, this was a reasonable buy the close. Look what happened, we tested it later in the day. So let's look at Friday real quick, and I really want to, I don't know why I just took that off. Anyways, so Friday, let's look at this question about how the significance of it, 3 consecutive bear bars making it always in. Let's take this example. Clearly we're always in long, but we had 3 consecutive bear bars, not enough to make it always in short. Look how many bull bars we've had. We're probably going to get a second leg up. Still, this was a reasonable buy the close, so we'll probably test it, which we did. Look at here. 2 decent legs up. We tested a logical place. We tested the open of the day. We tested this close, which was a reasonable buy the close. And buy the close bulls never were able to get out, and they were over here. Now you've had 3 consecutive bear bars in the upper portion of the trading range. It's also probably, this is probably the upper third of this leg down. Let's see. Oh, it's close. Anyways, this is probably enough to make always in bulls exit and some always in traders to go short. However, if they go short here, they get out above this bar or this close. Reason being, there's one problem about this leg down. It never fell below, well, it did not fall below support. Yeah, made a perfect double bottom and started to turn up. So theoretically, swing bulls are still long below this bar. So it's always in long still. It's kind of, so really to answer your question, or to answer this person's question about 3 consecutive bars, it has to do with, and it can be the same if it's a bear trend, the bulls don't want 3 consecutive bars. Try and find one real quick. Maybe you can argue bear trend, then 3 consecutive bull bars. Bears really don't want that. There's already anyway. So anyways, whenever the trend's really not strong or there's a lot of trading range price action, traders do not like to see, if there's a swing, they really don't want to see 3 bars in the opposite direction because it makes it very convincing to exit. And in some cases, when you tested logical targets, this close up here, we tested, there, we're at the top trading range, makes more sense for bears to short. And here's selling pressure, so it makes sense for them to short. We also probably got a measured move of this and even this. So if you make the argument it's always at the short, and you sold this close, your stop's probably up here. 1 times the risk is this low. No surprise. So I hope that covers that that question. And here's another question. Okay, this next question is about if a trader has obviously a small account or just doesn't want to risk much starting out, how do they trade risking around 2 points? Well, obviously you already know this because you already know answer in a way because you just implied it right here. When you risk 2 points, you have a very small risk. Look at the average bar. If I buy above this bar, the risk is 2.5 points. Look how big the average bar is. It's well over 3 points. So, with that said, you cannot achieve. You're going to trade. If you're trading only risking 2 points, you're going to have a low probability of success. Now, that doesn't mean you can't be profitable. You're going to have to go for rewards that are very big. So, for instance, well, it's hard, but it's doable. So, if we look more in this question, personally, I would really recommend if you have the ability to trade the Spider, which is the SPY, it's an ETF. I'd put 25 if you could put 25,000 in an account. I know that sounds extreme, but that way, if you're able to do that, you can trade very small, very, very small, such as, obviously you can trade 1 share. You could practice trading, 100 shares of the Spider and making, risking no more than like $15 on a trade, or even less than that. You wouldn't make anything because your commission would eat your profits, but you get a lot of experience and feel more able. So, yeah, if the sell-off, the risk is big. I said if you watch my video I made the other day over the November 6, 2015, this bar's big. Anyone selling down here, the stop goes up here, here. You sell here, put your stop, money stop 2 points, you're probably going to lose. So, you considered, hang on one second. I considered buying above bar 12 after big tails. Oh, I see what you're saying. So you considered buying that right here. That's perfectly reasonable. And if you do, if you buy it, what I would do, you have to risk more than 2 points. It's that simple. And I know you probably worked hard to get the money, or you're scared of losing the money or blowing the account. If you're going to trade, you have to remember probability. Traders starting out are always worried about risk, which is perfectly understandable. But you have to understand, when you give up risk and you lessen your risk, you're lessening probability. The market is never going to give you probability. You have to pay for that, and you pay for it with risk. So if you're going to buy, put my stop here, buy above, and I'd go for twice my risk. I would do that. Maybe do this, go for 2 times, and once it goes up to 1 times, I would consider moving my stop to break even. It's a hard thing to do, and well, actually, I take that back. What I would do personally, and it's not an easy thing to do. I'd buy above the bar, put my stop below, and I would go for twice the initial risk. So I'd put a target up here, right here, and I'm going to put a stop down there, and I'm going to wait until I either win or lose. And I know that seems kind of nerve-wracking because you get this and then you'd have to hold through this, but that is a way to trade. And it's not easy. Or I would say, here's a close. I'm going to bet the price gets up to here. The only way, if you're only risking 2 points, or you want to keep your risk very small, you have to go for very large targets because your probabilities can be very small. So if you want to sell under 16, right here, but I would do the same thing. You're going to have to risk more than 2 points, and I'm going to tell you flat out, just honestly, the reality is you're going to have to risk more than 2 points. Most days you're going to have to, but you don't have to risk much more than 2 points. For instance, you sell on a stop below this bar, 86.50 or 86.25. Sorry about that. I was looking at the wrong bar. If you sell at this, it'd be 88.75. It'd be 2.75. So it'd be like 11 ticks. And I know you're thinking that's a lot. It's around $135 a contract. That's a lot of money starting out, and it is. However, I would do that. And look right here. I would sell, stop up, and I'd go for twice the risk. And I maybe even go for 3 times the risk. Or look, say here's the sell at the close bar. I'm going to sell, betting the price gets to here. Well, you would have made at least 2 times your risk. So, really all I can tell you is if you're determined to trade the Emini and only risk around 2 points, and honestly, you're going to have to trade more than 2 points sometimes. I would take a stop entry. I look for good stop entry because by the looks of your question, you're talking about bars that make sense, but you're saying they're too big. However, for example, bar 22. Started the second leg down. So, and I think buying up here was good. And I would, honestly, what I would do is I would try to go for it at minimum, an absolute minimum of 2 times my initial risk on every trade. If I was only trading 2.2, because here's the thing. A trader who's put a stop up here and sold down here can easily achieve 1 times the risk down here, and that's why there's a lot of profit taking around this area. It's also close to this close. You can't do that. The probability is so high for a trader who sold here, stop up here. It's 60% that we'll get to here before here. It just is. And I know you want to be able to risk more, but you can't. So I'm telling you, I would right here. That's okay. Here's a stop entry. I'm going to sell. I know it's low probability. I'm going to put my stop above the bar, and I'm going to come back in 30 minutes. And I'm going to at least at a absolute minimum, I'm going to try and go for 2 times the risk. Or maybe you say, wow, what a great entry bar. I'll move my stop above here. And you're just trying to, you've got to try and go for big moves. Maybe you can see it here. You just buy above here, put your stop here, buy above, go for 3 times the risk. Better yet, I wouldn't even go for 2 times. I'd try and go for 3. And I would do an order cancels order if you have to, and walk away. So, you buy above here, go for 3 times. Maybe, honestly, 3 times is going to be probably too much, but you could probably do 2.5 times. Whoops, that's going to be messed up. I would go for over twice my risk. Do that, maybe, something like that. You need to catch big moves. I promise you, if you're buying and only going for 1.5 times your risk, I think you'll lose. And I'm only saying that because I just think that the math for if you're trading 2 points, if you're risking 2 points, you will have a low risk. Therefore, you need a large reward. So I hope that helps. And money management stocks the best a trader can do. Truth is, I would just if you would risk 3 points on average, you can put your stop below the bar. And I'm gonna be honest, I think it's so much better if you can do that. Just a simple money management stop, you may get stopped out. Right here. Let's pretend this bar is bigger than 2 points. You may at some point, if you're only risking 2 points, buy and put your stop right here, and instead of putting it below, look right here. This could happen on pretend this bar touched one tick above the stops, touched this low but didn't go below it, and then turned up. I know you'd feel really bad if you got stopped out right here, if you bought above this bar, and you might be thinking, if it stopped you out and turned up, you could think, gosh, if I would have just risked 2 more ticks or 3 more ticks, I'd still be in the trade. So all in all, I would just, it's hard because here's the thing. Trading range days are gunning for stops. I would maybe, these bars, they're just too big. I think you just have to step aside. I would say, okay, here's a possible bottom. 1, 2, 3, 4 pushes, 2 legs down. We've had a leg 1, leg 2. We're at the bottom. I'm just going to buy above this bar, and I will put my stop below, and I'll go for 2 times. And you don't make it. So then, maybe you get out somewhere in here back to break even. Not easy, but you can do it. You buy above here, then maybe if you're lucky, you get out break even, you get out small profit. Here, maybe you buy above this, it's second entry buy, you buy above here, and you say, okay, I'm going to try and go for at least 2 times the risk. Well, you could have gotten it. So that's the best thing I can tell you. I hope this helps, and let me know if you have any more questions.